Have y'all noticed how everything about the housing market is just a joke these days? Man, let me tell you, this market is so unstable, even a Jenga tower in an earthquake looks like a safer investment. Today we're breaking down why your dream home might as well be a unicorn right now. I mean, you can imagine it, but have you ever seen it in real life? This is Real Estate Rundown. Here we go. The housing market has traditionally been a beacon of stability, but is now hanging on the edge of a potential crash, full of uncertainty and speculation. Last year, we witnessed one of the lowest transaction volumes in 28 years. According to the National Association of Realtors, total existing home sales in the U.S. was just over 4 million units at the end of 2023, marking an 18.7% decline from the year before. That was the weakest year for home sales since 1995 and represents the largest annual decline since 2007, when the Great Recession was just getting started. So what's the underlying issue? What's causing the market slowdown? Well, there's a lot of distress among prominent housing industry groups like the National Association of Realtors, the Mortgage Bankers Association, and the National Association of Home Builders. And guess what? They're pointing fingers at the Federal Reserve, calling for greater transparency regarding the Fed's interest rate plans, because they would rather see more stability and predictability in the housing market. The uncertainty of the market is aggravating housing affordability issues as interest rates remain elevated. The higher mortgage rates reflect higher yields in the bond market and a relatively wide premium spread between 10-year U.S. Treasury notes and mortgage rates, nearly double what it was just 2 years ago. The wider spread between mortgage rates and Treasury rates reflects a lack of buyers for mortgage-backed securities. Meanwhile, the Fed is unloading its own holdings of mortgage-backed securities by $35 billion per month. If the Fed decided to stop dumping off its mortgage bond balance sheet, it might help bring mortgage rates down a bit. The banks, in turn, are facing significant challenges of their own. According to Bloomberg, City National Bank in Los Angeles, known for serving Hollywood's elite, recently made headlines after laying off approximately 100 employees. This happened shortly after an earlier workforce reduction of 5% in the previous quarter, highlighting the bank's ongoing struggle. With around 6,200 employees, City National's difficulties mirror the broader economic turbulence that is reflected in the troubled housing market. If you are involved in real estate, you know that the industry is flooded with agents and mortgage professionals on social media promoting the buy now or regret it later narrative. While social media feeds hype up the market's potential, suggesting a fear of missing out, industry leaders and the raw data paint a grim picture of the market's direction. Some industry leaders even argue that the Fed needs to raise interest rates to prevent a total market freeze. Their thinking is that if rates remain low, we will continue to struggle with a sluggish pace, primarily due to a lack of inventory. Yet the real issue lies in the affordability crisis. Rob Barber, CEO of Atom Data Solutions, points out that despite rising rental rates and home prices, renting remains more affordable than owning in almost 90% of local markets nationwide. This trend is driven by soaring home prices, making ownership increasingly unattainable for average workers. Let's break that down. The current 30-year fixed mortgage rates range between 6.5% to 7%. For someone earning around 75 grand a year with other monthly debts of about $500, they should be looking to buy a home in the $200,000 range in order to qualify for the mortgage and be confident that it fits their budget. The problem is that in most areas, the average or median home price is closer to $400,000. So even if the combined household income is 100 to 150 grand, it's still going to be very difficult to afford a home. Combine this affordability issue with the fact that sellers are reluctant to sell because they don't want to give up a terrific low rate, it's easy to see why the housing market is the way that it is. Okay, so many potential sellers are in a good place financially and don't have to sell. But there are a lot of other folks that have a need to sell. The problem is that those sellers typically have an unrealistic outlook on the value of their home. They will play the aggressive pricing game and wait for the right buyer to come along. Because, I mean, what have they got to lose? They know that someone will eventually pay the price and suck up that high interest rate just to get a house. Karma will eventually catch up to those sellers when they have to buy again or become someone else's tenant. Meanwhile, the trade organizations are calling for the central bank to lower interest rates and inject more money into the system. To them, it doesn't really matter that this could lead to additional price spikes over the next few years, further inflating the bubble without any meaningful wage increases to help ease the pain. This whole situation highlights the critical issue in real estate. The market won't improve if we keep doing what we're doing. Continuing to put properties on the market that people can't afford isn't working. The industry's desire is straightforward. If the market recovers, more realtors will profit, leading to increased financial circulation. Yet, what advantages does this offer to consumers? Advocating for policies that inflate housing prices does not assist prospective buyers. And the aggressive strategies employed by some to stoke fear of missing out doesn't help much either. These tactics promote the notion that real wealth comes from owning real estate, as the net worth of renters is compared to that of homeowners, all while ignoring the real issues. Housing should be viewed as a basic need, not just an investment. It's essential to focus on what's best for families in terms of shelter costs, rather than pushing homeownership as the ultimate goal. Buying a house involves significant expenses. If someone is selling you on the idea that it's a great investment, then perhaps it's good to take a step back and question whether they are genuinely looking out for your financial well-being or just pushing you towards a costly decision. At this juncture, one has to wonder about the housing market. Is this the peak, or is it the valley? Either way, it's essential to be cautious. Making a purchase in today's market can be risky. The corporate investors are guarded in their position, so that should tell you something. If you're considering buying, weigh your options carefully and make a decision based on your personal financial situation and not necessarily just from an investment perspective. The investment thing will typically work out well for you if you can manage to stay, improve, and maintain for 5 years. What are your thoughts on the current market trends? Let us know in the comments section below. We appreciate it if you give us a thumbs up and subscribe to our channel. This is Real Estate Rundown. See you again next time.